Hello and welcome to Simply Tax. It's Wednesday, March 10, 2021, and sorry. Hold on, let me step back inside real quick. Aha, much better. It's Wednesday, March 10, 2021, and to borrow the words of AICPA President and CEO Barry Melancon at the AICPA Town Hall on March 4th, we are in the eye of the storm when it comes to the tax and accounting world right now. We have the ongoing impact of a global pandemic, a flurry of recent developments in Washington, following, of course, a flurry of developments in the last year coming from Washington, digesting and keeping up with the latest on things like the Paycheck Protection Program and Employee Retention Credit, and of course, who could forget the partnership tax basis capital reporting that we talked about in episode 118, or even implementing the changes under the recent guidance on the Tax Cuts and Jobs Act provisions like Section 163J, or even our favorite topic 199 Cap A that we had some fun with on our last episode 119 of the podcast. With all of that in mind, I think it's safe to say this is shaping up to be another one of those tax seasons I'll be telling my grandchildren about someday, when I also describe my walk to work during the pandemic, with no shoes. Of course, since my wool socks will do just fine heading over from the living room. And so, I did what I often do when the tax headlines are swirling, and that's call up the original, the only one, the Vice President of Taxation at the AICPA. That's right, guest Ed Karl's back. All right. Good place to start, and it's obviously a bit of a moving target, as probably everything in the last year has been, perhaps. But taking a look at this latest stimulus package, where we are, what's in it, and maybe how to even approach it from a taxpayer and a tax practitioner perspective.
Yeah, and a lot of the interviews, it's hard to get all of the exact information, and when you get a bill that's over 600 pages and a lot of the versions that are out there now don't have some kind of an index and where information is found, and you're sifting through it. And is it the correct version? Was it the Saturday version, or was it the pre-Saturday changes? I've seen some incorrect information out there with some of the news media online. Well, here's a calculator to calculate your $1,400, your rebate checks, and they had a link to the bill, and the bill was wrong because the phase-out amounts in the bill were incorrect. So they were changed. So right on Saturday, the big issue in the Senate was to try to more closely target the rebate checks to those taxpayers who need the money. So they lowered the phase-out threshold. So it phases out much quicker. So it's up to, for an individual, $75,000. But instead of phasing out at $100,000, it phases out at $80,000, and pretty much double for married filing joint. So getting the correct information is really a bit of a challenge, but you also have information that impacts 2020, where we're already into March and returns are filed. And then you have tax information in there that impacts 2021. For example, the exclusion now of $10,200 of unemployment benefits, when many taxpayers have already filed a return. So now we're looking at a lot of amended returns having to be processed by IRS.
Yeah, any thoughts on that? I mean, obviously this isn't the first time we've had a retroactive change that would require amended returns and whatnot, but it perhaps is affecting also a larger number, or maybe it's hard to know even if it's a larger number or not of individuals. Any thoughts, suggestions, or tips on how to approach that?
You're right. It's not the first time this has happened. Congress is looking at needs and trying to make an overall decision, and basically leaving up to tax administrators. And I would include, you normally wouldn't include CPAs in that, but from the preparers as part of the tax system are going to have to bear the brunt of having to clean that one up. So I think as of last week, H&R Block was asked by the House Ways and Means Oversight Subcommittee how many returns they've filed or what percent of the returns they filed had unemployment in there. And this was as of about 2 weeks ago. So about the middle third week of February, and it was 19% of the returns that H&R Block does had unemployment. So that means, and they file millions of returns. I think they file upwards of something like 100 million returns or 75 to 100 million returns. So you're talking about a lot of returns that now have to be amended. But it's a benefit for taxpayers, and the majority of taxpayers, of those 19%, something like 91% got a refund. They may get a larger refund, or people who paid tax now might get a refund. So $10,200 of exclusion for a single individual, double that for married filing joint, to the extent that each spouse received unemployment. So that's a good chunk of money. And that has to be fixed somehow. I would suggest for most preparers who are struggling right now, even for those who don't want April 15th to change, it's not an easy year, just like it was not easy last year. The last thing they need is to have to go back and amend a substantial portion of returns that were filed. So I suspect that that's going to have to wait till they get through the substantial part of busy season, whatever that might ultimately wind up being.
The process of amending is never easy, although I guess maybe some good news. That I know something that the AICPA and your group has been working on, at least advocating for a while, in terms of electronic filing of those amended returns. So I guess perhaps got that factor going. But before we leave the legislation, any other elements or things you would maybe highlight from the conversations that went into it, and kind of where to look to unpack what some of these benefits are and how to make sure that everybody's taking advantage of them?
You know, there are benefits, societal benefits in there. There's money for vaccination delivery, and state and local money is going out to the whole country, and things like that, as opposed to tax provisions. We as CPAs are always interested in the tax pieces, and obviously understandable, but there's a lot more in that bill as well. So from a tax perspective, as I mentioned, there are pieces like the rebate checks and exclusion of unemployment that impacts 2020. There are provisions that impact 2021, one of which, the child credit, has become an advance payment that the IRS has to figure out. So that's going to take some resources away from the IRS. And the last I looked, I didn't see any additional resources given to IRS to figure this out. So that has me a little bit concerned, not from the policy perspective, but we know last year they struggled. They struggled because they had to make sure their staff was safe with the pandemic impacting everybody. Even when they came back on board, they had to figure out how to social distance their workers. So it was not an easy year for them. And obviously, as we all were doing, making sure the health and safety of our staff comes number one, and same thing for IRS. But meanwhile, we all know about the backup of the mail and the backup of the processing, and because of the changed dates, there wasn't a hold put on some of the notice cycles, and goes around in circles and circles and creates quite a mess for CPAs. And so that's where I'm going, where they're going to have to put resources into figuring out how to get advanced child care credit payments out to the correct individuals is going to take time and resources away from things they could otherwise be doing. And that gets me a little bit nervous.
So I guess with that in mind, I know that the AICPA made a recent recommendation here that the Treasury and the IRS looked at quickly and provide some relief by postponing the deadline. And I know too that there's we've talked about on the podcast before that it's to an extent, a divisive issue, I guess you'll say, where there's people on both sides of that. But maybe talk a little bit about that and kind of where things stand at this point in time.
Our membership is quite diverse. There are 44,000 firms. There are many small firms, but they're all over the country. There are medium and large size firms. COVID impacted them and still impacts them in different ways. They have different issues about the way IRS issues are impacting their firms. So our membership is split on whether they want a change from April 15th or not. I would suspect that a lot more want a change in April 15th, but some of the ramifications from 2020 of changing the due dates, which were not positive. We just talked about the mail backlog and the processing backlog, and they're still updating 2019 return information into the master file. And that's what people are worried about. If you change those dates, will IRS manage that properly? And I understand why people would be concerned about that. Because of that split, because of state conformity issues, we were taking a very cautious attitude towards this. We've been looking at this probably since a year ago. We started talking about the year anniversary of the presidential declaration of emergency. March 13th is coming up. And we've been dealing with due date issues since then. Nonstop, and even getting past July 15th last year, October 15th, and starting to worry and think about 2021 filing season and what's the best answer for everyone as a whole when you have a diverse membership. We follow it on a day-to-day basis. And so we did do a survey. Several members have reached out to me and said, why didn't you ask for the membership's opinion? We did that in February. We did a survey and we got it out through a lot of different channels, our tax section channel and through the CPA Letter Daily and through social media. And we had twice the number of participants in the survey as we did in the survey we did last June. And again, people were split, but we had about 1,500 comments about why people felt the way they felt. So it was important to ask people what they thought, even though they had diverse opinions. We wanted to see what they thought and have that as an important data point in our decision-making process. Not the only data point, but an important data point. And a number of people who reached out to us with concerns that we are now advocating for a change said, why didn't you ask the membership? Well, we did. We did ask the membership. Several weeks ago, our position was that there were indications that IRS would be forced to change April 15th because of the recovery legislation. And we wanted them to make a decision sooner rather than later. I think the worst result is making a change just before the 15th of April. That was a big concern. It would give no opportunity for states to conform. And we were concerned about that. We were also concerned about the dates we were hearing. Congress has started to push or talk about July 15th, which we think is a problem because, again, 46 states have June 30 fiscal year ends. From a balanced budget perspective, they need the money before June 30th. Extending to July 15th is a problem. We heard some indication that IRS was thinking about May 15th, and I've spoken to a lot of CPAs who said they want to give their staff a break at April 15th. They did not do that last year because of the July 15th extension. And they felt in retrospect it was a problem, so they want to start giving their staff a break starting at April 15th. Maybe a rolling break, not everyone at once, but giving some staff a break starting at April 15th. If you have a May 15th deadline, that becomes hard to manage. So we asked IRS to if they're going to change, make a decision by March 1st. And if they do change it, June 15th should be the date. March 1st came and went. They did not say anything. Our indications, though, that there seems to be a sense of inevitability about the need to change April 15th. We're hearing more and more bad notices coming out that the CPAs have to deal with on behalf of their clients. And more people are saying they're sick, even though things are, thank God, improving. But still, taxpayers are afraid to come into offices and bring information, and particularly the elderly have no other way to send it to their CPAs other than to bring it in, or the CPA to meet with them somehow. So all these things are building to a crescendo. The need to retroactively change IRS systems for this recovery legislation that is about to be signed by the president, most likely. How do they change for the unemployment exclusion, and how do they make changes for the recovery rebate? Their systems are going to have to be pulled offline. We knew from the December legislation that it caused a 2-week delay in the start of tax season. So maybe it's not 2 weeks now, but there's going to be some time where they have to take the system offline. It's a long-winded way of saying it seems to be inevitable, to the point where we came out with a position last week saying that IRS should just change the due date to June 15th. Just come out and do it. We're concerned about the ramifications of it, and we're talking to IRS about doing a better job of managing the notice process. But we believe the date has to change to June 15th. They need to do it now so it gives states a better opportunity of conforming their dates, because we all know that if IRS changes the date but state returns have to be filed, it really negates most of the benefit of having any kind of a change date.
In those conversations, I guess, on the notices and maybe the process there, what's the latest there, and what are maybe some ways forward that the IRS may be able to kind of get out from some of the backlog and cut things off of the pass before they become issues with notices down the road?
Well, what they did last April 15th was they put a hold on the notice cycle to accommodate the change to July 15th. Part of the problem they had last year was they had printed out millions of notices in March last year and then held them, and then they mailed them once things came online again after July 15th. But the problem was those notices said you owe an amount and it's due by whenever, June 1st or June 15th, yet everything was deferred until July 15th. And so it created a lot of confusion. Some of those returns had stuffers indicating the changes, but a lot of CPAs told us they never saw stuffers in those notices. So it created mass confusion. One of the reasons the IRS did it is because it cost them millions of dollars to print out those notices. So there's a cost-benefit process they have to go through. On the other hand, a lot of the costs were shifted to taxpayers and the CPAs who represented them. So we're trying to talk to them about doing a broader thinking about that cost-benefit analysis and putting a hold on some of those notices, the notice cycle, to accommodate their limited capacity. Having the limited capacity because of COVID was completely understandable, but not accommodating that notice cycle for that was a little confusing for us.
Receiving some of those firsthand, I can say that, that definitely causes worry and concern sometimes. I guess as we maybe look beyond the filing season, whenever that is and whenever that ends, I think a topic that I've been talking about quite frequently with those that I work with and just getting a lot of questions on is maybe kind of the outlook and the prospect of changes maybe later in the year or additional tax changes this year, particularly perhaps given the fact that we had a change in the White House and the Biden administration and some of the proposals from the campaign. I guess what's the latest there? What are you hearing, and what are you going to be closely watching here as we get out of the filing season?
So there were discussions from the campaign about some corporate changes, raising the corporate rate, some of the international rules, some of the rates or rules impacting high net worth individuals. So I'm talking like $1 million, but we don't talk about $1 million. We as CPAs talk about $1 million AGI or $1 million gross income or $1 million taxable income. We don't talk about $1 million. And so that is an inherent problem with campaign information. There were not a lot of specifics. And as you can imagine, if you were running for office, you wouldn't put tax increase information prominently on your website. So trying to figure out what the Biden campaign's tax proposals were, it was not an easy chore. It was quite a challenge. And so what we're looking for right now, over the next week or two, the administration will release its budget for the upcoming year. One of the items that comes along with a budget are revenue raisers, tax changes. And so we're looking for those to come out. The Treasury Department usually releases something called a Green Book, which is an articulation of what they would look towards in terms of tax changes to fund part of the budget. And the last 4 years, we didn't see that written articulation. It's called a Green Book, the Treasury Green Book. And we did ask some Treasury officials last week if they would be going back to releasing a Green Book, and we were told yes. Usually the budget is released the first week of February, except in the first year of a new administration. And so that usually comes out sometime in mid to late March. And so that's when we're expecting the budget and the Green Book, and that'll give us more details about what they're thinking about in terms of tax changes. Let me just talk about a couple quick ones. So, for example, there was talk about raising the corporate rate back up to 28%. I think there's a possibility of the corporate rate going back up. I don't think it'll go back up all the way to 28%, maybe a cap it at 25%, but there's a possibility of the corporate rate going back up. They're talking also about minimum tax changes for corporations, possibly changing the capital gains rate. They mentioned, raising the capital gains rate for those earning above $1 million individuals. So again, is it taxable income? Is it AGI? As we typically think about, I don't know. We don't know yet. That could be in the Green Book when it comes out. So those are just several examples. Having gone through that long conversation about changes, even though the Democrats control the Senate and the House, the margins are so slim. And we have relatively conservative Democrats in both chambers. We saw what happened with the stimulus legislation where for example, Senator Manchin from West Virginia was concerned about the rebate checks not being properly targeted. So they reduced the phase-out thresholds. So those are the types of things that we see when there is a very narrow margin in the chambers. And so passing tax legislation is not a slam dunk. It would probably have to be done under reconciliation, just as they did with the COVID legislation that is about to pass, where they only require a simple majority rather than the supermajority as the normal rules for the Senate. That generally can only be done once in a year. And so they're using it right now for this current legislation under the reconciliation rules, and it'll pass the Senate Saturday 51-50, with the vice president breaking the tie. The oddity is that they can do it again for the next fiscal year beginning October 1st, 2021. So they could do it twice in the calendar year, but once each fiscal year. So it's possible that they may start to talk about tax legislation, but it couldn't pass until the new fiscal year. So we're looking on probably not before October.
And so there'll probably be a lot more discussion between now and then, obviously, I'm sure. And yeah, like you said, look for the green book and the details.
The Green Book and discussion, you're 100% right. There could possibly be, Ways and Means committees start scheduling some hearings to talk about some of the items in the Green Book or some other proposals. So even though the serious consideration for legislation couldn't take place until the latter part of the year, there could be some exploration of ideas earlier.
Your group in particular is very involved in helping with, being a sounding board, perhaps, or bringing up issues or policy concerns and advocating for CPAs and the profession. Will that kind of be the case again, you would expect, as things kind of heat up again, maybe looking towards the fall?
Yeah, absolutely. And we already started, I would say, last October, November. Our committees split up the best that we could, but various Biden campaign proposals just to sort of get an early sense as to what was out there and which of our groups would track them. So we already started that discussion last fall. The next waypoint for us would be the Treasury Green Book that I mentioned, and to see if the administration may be serious about moving proposals forward. Now, the Treasury Green Book is not legislation. The administration does not enact legislation. That comes from Congress. The administration spends the money. That's what their budget is for, and they propose how it should be paid for. But it's Congress that has to enact the spending limits. Congress has to enact how to pay for it through legislation. So a green book gives us a picture in time. It doesn't mean that it will pass.
Maybe switching gears a bit, but I guess sort of related since we were talking about some of the administration changes. But I know a topic that we've frequently talked about when we've gotten together here is the taxation of the digital economy. And I know there's been some recent developments, and the conversations continue. But any thoughts or perspectives or developments that we should be keeping an eye on there?
Well, there's an acting assistant secretary for tax policy, Mark Mazur. They haven't named a permanent deputy, so that's a key position to have. On the other hand, Janet Yellen was asked about the administration's position on that at her confirmation hearings in the Senate, and frankly, not too surprisingly, her position is not unsimilar to the Trump administration's position. A lot of the income being generated from a digital economy comes from U.S. companies. And so Treasury Department is going to be cautious about what goes on from the taxation of the digital economy, because it will be U.S. companies that are going to pay a disproportionate share of those taxes. It's likely that the administration's position will be somewhat similar, although at one point there was a comment about these two pillars of the OECD digital tax process. So they had two pillars that they were looking at. Pillar one talked about some kind of a profit allocation, and pillar two was a minimum tax. At one point, Secretary Mnuchin talked about Pillar 1 being viewed as sort of a safe harbor. And I think most people believe that's not workable from a sort of a global perspective of having it as a safe harbor. The Trump administration seemed to move away from that towards the end of last year. And it's likely that's where the Biden administration will be, is trying to look at some kind of Pillar 1 and Pillar 2, not as safe harbors. The OECD postponed their decisions that they were trying to get because of the pandemic, but they're looking towards sometime this year, 2021, is trying to get some kind of an initial consensus on what the framework would be to tax the digitalization of the economy. So more to come on that this year, and more to come from AICPA on that as well.
I feel like that's always the theme of our conversations, Ed, is there's a lot happening and it just seems to kind of continue to build. Covered obviously a lot of ground here. Speaking of that, anything that maybe we haven't covered or that you'd like to add and or maybe just some kind of overall closing thoughts?
Number one, the up and coming issue also, and I'm not going to talk too much about it, but just to throw it out. I know you've had conversations with my staff about it, but virtual currencies will continue to grow in importance, and there'll be more information this year. I understand that there is confusion about the question on the 1040 about virtual currency, so we're trying to get some clarification in that area. But I think that's an important and growing aspect of the economy, and it will be a growing and important aspect of the tax system as well. And you've spoken to my staff, Amy Wong. Her name now, she's changed to married name Miller, Amy Miller. But she's quite a resource in the virtual currency area.
I couldn't agree more with Ed, but you can hear and judge for yourself by giving episode 118 a listen, starting at the 3-minute and 20-second mark.
I think also a growing area, and it ties into tax season also, but state conformity continues to be a growing important area. You look at, just as one example, the unemployment taxation exclusion, the $10,200 that we talked about, that looks like it's on the threshold of passing and will be retroactive to 2020. How many states will conform to that? And how do you deal with that on a state return? And so state taxation conformity, just constantly growing. It's always been an important issue. Last thing I'll throw out, the rules regarding cannabis and the growing interest in Congress about addressing some of the challenges. That will continue to be an issue for CPAs to deal with, for society to deal with, and I think it'll be of growing importance for us to talk about that. And the last thing, Damien, that I would close with is about filing season and the due date, and just keeping a close eye on what's going to happen and when. Will IRS defer the April 15th, and exactly how do they do it, and to what date, and when do they make that decision, and will states be able to conform to a change if there is a change? So that's really something that is very heavy on our minds right now, and how to make the tax system work, even though it's at the tail end of the pandemic. Hopefully, it's still a lot of the ramifications from last filing season are still on us. We're not completely out of the woods yet, and it impacts filing season. So that's something to keep a close eye on.
I have to say, I always look forward to updates from Ed, and I think he didn't disappoint, as usual, in our conversation today. Check out the show notes of the episode to learn more about Ed, the AICPA, and the items that we discussed, which are available at bkd.com/simplytax. I would also really appreciate a rating and review on Apple Podcasts, and if you would drop us an email at simplytax@bkd.com to let us know what you think. I'm Damian Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.